Good afternoon, everyone. Thank you for joining the Endowus Portfolio Performance and 2025 Market Insights. My name is Hugh. I lead the investment office at Endowus, and I'm joined by my colleague, Sean. Before we start, I think on the next page, we will start with some disclaimers. Can we move on to the next page? And the next page, please. So we currently have the Slidos open for questions that we will answer after we finish with our presentation. Next page. So as all of you are clients, you will probably know Endowus by now, but Endowus is a conflict-free institutional access, low fair fees platform that give you conflict-free access to institutional shares. We are also have shareholders from prominent organizations such as UBS, Citi Ventures, MUFG, Samsung, etc. Very recently, we closed the latest fundraising round, making us raise a total of over $110 million. And along with some existing investors like Prosus and UBS, we've invited some new investors to our league table, including OSK Ventures from Malaysia, but also the Impact Fund from Jay Lin, the famous basketball player Jeremy Lin, as well as investments in Korea. The next page. So we'll start with the fourth quarter and the 2024 market review. Then we'll go over Endowus portfolio performances covered by my colleague Sean, and then we'll look at 2025 outlook and strategy. So as you can see in the chart here, 2024 was another year where global equities performed really well. Over the course of the year, global equities rose over 20%, and this compares to global fixed income, which was only up about 1.7%. Commodities, on the other hand, performed in line between global equities and fixed income, with up about 8%. Next page. I think there's a little bit of lag in the presentation. Can we move on to the next page, please? Okay, as we try to move on to the next page, the performance of the markets in 2024 has really been characterized by the strength of the tech sector and AI-driven companies in particular. But what's important or what's interesting is that it wasn't just the tech sector in the US that performed, it was also financials. And if you look at risk-adjusted returns, financials actually performed even better than the tech sector, which actually leads us into the 2025 outlook that we're going to go through later on. But largely, the performance of equities was driven by US mega caps on an absolute basis. Next page. The other observation that we can make is that US exceptionalism has continued with the US sector really differentiating its performance from the rest of the world. As you can see on the chart at the left, US markets were up above 25%. The rest of the world, a lot more lukewarm performance. Again, a big part of that was the divergence in performance between US mega cap and the rest of the world. As you can see, because of that, the concentration of the market has really increased, as you see from the chart on the right. This is the most amount of concentration that we've seen since really the 1970s. Next page. So on a fixed income side, very similarly to risk assets, the highest risk assets have performed the best, and this is high yield. So on a 2024 basis, European high yield and US high yield were the best performing sectors. And a big part of that was because credit spreads had narrowed, and a very similar phenomenon to what happened to equities happened on the fixed income side. Next page. If you look at the difference between the shorter term and the longer term yields, you'll see that in the earlier part of 2024 and also 2023, what we call the yield curve was inverted, meaning the 2-year or the shorter term yields higher than the longer term. But the natural state of the yield curve is for it to steepen, whereby the longer term yields are higher than the shorter term. And this is what's happened, towards the latter part of 2024 and early 2025. Now you're seeing the longer term yields higher than the short term yields, and we expect this trend to continue. Next page. So with that, I'll hand it over to my colleague Sean to go over Endowus portfolios.
Thank you, Hugh. Hi, everyone. My name is Sean. I'm the investment advisory lead at Endowus. So after looking at the Q4 2024 market review, let us now look at how Endowus portfolios performed in the last quarter of 2024. Next slide. Yeah. So starting out with SRI's flagship portfolio, on the equity side, the equity portfolio continued to deliver positive returns in the fourth quarter last year, posting a return of 4.6% while keeping pace with the broader global equity markets. And on the fixed income side, the flagship cash and SRI's fixed income portfolio generated slightly negative returns, but also outperformed the broader fixed income market by about 0.7%. And over the 1-year period, the 100% equity portfolio underperformed the benchmark slightly by about 0.5%, while the fixed income side of the portfolio outperformed its benchmark by 1.6%. And just a quick recap, the 100% equity portfolio has structural tilts towards value and small caps factors via the dimensional funds in the portfolio. So throughout this review, we will be using terms like factors, tilts, value, small caps, and all these terms. I understand that many of the audience today are already very familiar with all these terms in our flagship portfolio. But for those of you who are less familiar with these terms, we publish a lot of useful contents on our website and also on YouTube, our social media. So I would highly encourage you to familiarize yourself with these terms, because these will be very helpful in your investment journey. And just coming back to the performance of the portfolio, so the equity portfolio faced quite a bit of headwinds in the last quarter, having a slight overweight towards value, emerging markets, and also small cap, as we mentioned just now. And therefore, the performance lagged its benchmark slightly. And just going into the portfolio, there are 7 funds on the equity side of this portfolio. The Amundi Prime USA Fund and the iShares US Index Funds, which are passive index funds tracking the US equity indices closely. These 2 funds were the best performers in the equity sleeve. The dimensional funds, on the other hand, the performance were hampered by the exposure to size and value factors, and in particular, the dimensional Pacific Basin Small Companies Fund, which was the main contributor to performance in the third quarter, became the main detractor in the last quarter of 2024, as its exposure to small caps, detracted from relative performance. And these similar detractors were in play across the 1-year period as well. And shifting to the 100% fixed income portfolio, the portfolio outperformed the global fixed income market in the fourth quarter, which is helped primarily by its allocation to shorter duration bonds relative to the index. The short duration bonds outperformed longer duration bonds with lower volatility in the last quarter. And during this period, we saw that the 10-year Treasury yield rose meaningfully and finished the year at around 4.6%, on the back of stronger than expected economic data, which led the market to kind of recalibrate the inflation and rate cut trajectory this year. And within the fixed income portfolio, again, there are 7 fixed income funds, and the iShares Global Aggregate 1 to 5-year Bond Fund was the best performer in the quarter because of its shorter duration, which contributed to the portfolio's relative performance. The PIMCO Emerging Market Bond Fund was the main contributor to performance in the third quarter of 2024, but this fund became the main detractor in the last quarter. And just moving on to the CPF flagship portfolio, the flagship CPF 100% equity portfolio posted positive returns in the last quarter of last year and outperformed the global equity markets by about 0.3%. And over the 1 year period, the equity portfolio returned 21.7%, which also outperformed the global equity benchmark by about 1.4%. And looking at the fixed income portfolio, the portfolio returned 1.5%, performing in line with the broader fixed income benchmark. The fixed income benchmark generated about 1.4% for the year. Again, zooming into the portfolio itself, within the equity portfolio, the Amundi Prime USA Fund was the best performing fund for the quarter and the year, as the US market outperformed most of the other major markets. The largest detractor from relative performance was the overweight to emerging markets through the Dimensional EM Large Cap Core Equity Fund, and also the Schroder Global Emerging Market Opportunities Fund, as EM underperformed developed markets. And this similar detractor will in play over the 1 year period as well. And moving over to fixed income side of the portfolio, again, the 100% fixed income portfolio performed almost in line with the broader fixed income market in the last quarter of 2024. And the strongest performing fund for the quarter was United SGD Fund, which benefited from its short duration positioning. The main detractor was the Dimensional Global Core Fixed Income Fund, which conversely suffered from its longer duration, and this observation was seen across the 1 year period as well. And just moving to our ESG portfolio on the next page. So the ESG equity portfolio generated positive return in the fourth quarter of 2024, but it fell short slightly as when we compare it to the benchmark. And the underperformance was due mainly to two factors. Number one is the portfolio's longer duration profile, and secondly, its lower allocation to mega cap tech stocks. And while these factors impacted mostly the active allocation within the portfolio, the more passive funds in the portfolio were actually the main contributor to overall portfolio performance. One of the detractors was KBI Global Sustainable Infrastructure Fund. This fund actually has a defensive characteristic, but the fund was negatively impacted by rising interest rate, and also there was a shift in investors' preferences away from sectors such as utilities and infrastructure towards higher growth sectors. And also the EM emerging markets also underperformed the developed markets during the quarter, as Trump's election was seen as a potential challenge for the region. And looking at the ESG fixed income component, the ESG fixed income portfolio underperformed the benchmark slightly in the fourth quarter by about 0.3%. The portfolio's overweight in investment grade credit was a detractor. But on the other hand, the portfolio's allocation to Asian bond market by Eastspring Asia ESG bond helped to cushion the downside. And despite the challenging fourth quarter, the portfolio ended the year outperforming the benchmark by 0.4%. And going over to factors portfolio, the Factors 100% equity portfolio underperformed its benchmark over the quarter, while the Factor 100% fixed income portfolio outperformed the global fixed income markets. Within the equity portfolio, the Global Core Equity Fund contributed mostly to the portfolio's performance over the quarter, while the Emerging Market Sustainability Core Equity Fund and the Pacific Basin Small Companies Fund were the main detractor and ended the quarter with negative performance. The fixed income portfolio outperformed the Bloomberg Global Aggregate Index, which represents the global fixed income market, and the Global Core Fixed Income Fund slightly underperformed the index. But the shorter duration funds in the portfolio play a key role in generating positive returns and stabilizing the overall performance of the portfolio. And just as a quick recap, many of you are already very familiar with Factors Investing and Dimensional as a fund manager, but we want to also highlight that the factor premia are long-term in nature, and investors that maintain exposure to them over the long-term horizon are generally rewarded. But of course, it is always possible for the funds to underperform from time to time over the short term. And moving to the income portfolio, we have three income portfolio here, and all three income portfolios are achieving their payout targets. Again, a quick recap: stable income portfolio has a payout target of 5 to 6% per annum, Higher income has a payout target of 5.5 to 6.5% per annum, and future income has a payout of 3.5 to 4.5% per annum. So if stable and consistent monthly payout is something that you would like, something you are looking for, maybe we can look at our suite of income portfolio. And coming back to the performance, zooming into the stable income portfolio, the fourth quarter of 2024 was a challenging quarter for fixed income in general. The stable income portfolio declined by 1.3% in the fourth quarter, but this actually is outperforming the broader credit market. And the portfolio's shorter duration relative to the benchmark contributed to its better performance. And in particular, the Neuberger Berman short duration emerging markets bond fund was the fund that generated positive performance in a quarter in this generally unfavorable environment for fixed income. The other fund that is JP Morgan Income Fund, which delivered the second most resilient performance as a result of its defensive duration positioning in the quarter. And looking at higher income portfolio, the higher income portfolio declined by 1.3%, underperforming its 20% equity, 80% fixed income benchmark. This higher income portfolio, its asset allocation has 20% equity and 80% fixed income, and therefore the benchmark is as such. The fixed income component of this portfolio was more resilient than the broader credit market, and thanks to its shorter duration and allocation to higher market, which helped with the overall performance. However, the equity component of the portfolio faced a few headwinds, and it lagged the broader equities market due to its overweight exposure to listed real estate and also Asian equities, and also its underweight exposure to large cap growth stocks, such as the Magnificent Seven. In addition, as most of the underlying equities funds are currency hedged, there was a significant appreciation in USD against SGD, and this proved to be a headwind for the higher income portfolio in the quarter. And lastly, for the future income portfolio, the portfolio delivered a positive 0.2% return, underperforming its benchmark of 40% equity, 60% fixed income in the fourth quarter. The fixed income component mirrors that of the stable income portfolio and was more resilient than the credit market. But again, its equity component, on the other hand, underperformed the broader equities market. Similar to higher income portfolio, currency hedging of some of the underlying equity funds, as well as its underlying underweight position to large cap growth stocks, distracted from relative performance. However, the positive security selection in European and Asian equities helped to offset some of this underperformance. And for the full year of 2024, the future income portfolio performed in line with the 40-60 benchmark, while also meeting its 3.5 to 4.5% payout target. And moving on to our suite of cash smart portfolio, the cash smart portfolio delivered positive returns in the last quarter of 2024. And each finishing the year strongly and in line with their respective objective. And as the rate environment normalizes, we observe that the return of these three cash smart portfolios are aligning with their respective risk profile. So cash smart secure is the lowest risk, followed by cash smart enhanced, followed by cash smart ultra, which has the highest risk among these three cash smart portfolios, and its return are in line with their risk profile. And just really quickly moving on to our satellite portfolio, starting with China equity portfolio, which registered negative return in the fourth quarter of 2024. I think despite the promising stimulus measures announced by the central bank in September last year, the market optimism weakened over the quarter, and allocation to funds with exposure to Greater China markets, such as Taiwan, as well as its value-tilted strategies within the portfolio, which were more defensively positioned. All these factors aided in cushioning the overall performance in the market decline. And for global real assets portfolio, the portfolio faced considerable headwinds in the fourth quarter of 2024, detracted by about 8.2%. Most of the negative performance came in December on the back of a reduction in rate cut expectation this year, coupled with a sell-off in climate transition equities. And for the megatrends portfolio, in the last quarter of 2024, which was a rather eventful quarter, with several key events in US having a large impact on equity returns. I think that Trump's triumphs in the US presidential election contributed positively to the portfolio's return in November, as investors looked forward to a lower taxes and more business-friendly environment. However, the Fed's stance in December shocked the market and resulted in 2024 ending on the sour note. Volatility was also seen in FX, where the USD depreciated against Sing dollar over the quarter. For the technology portfolio, the portfolio delivered 1.1% gain in December 2024, bringing the fourth quarter return to 8.2% and closing the whole year of 2024 with a positive 23.3% return. And during the quarter, the portfolio delivered attractive return despite market challenges. In October, the portfolio return was in line with the broader tech sector, with the communication sector showing resilience during an uncertain period surrounding the US presidential election and also moderating global growth. November was a strong month. US tech companies and smaller non-US firms benefited from pro-growth sentiment after the US presidential election. In December, again, we saw resilient return with larger and more established tech players generating positive performance. With that, I will hand the time back to Hugh, who will bring us to the 2025 insights.
Thank you, Sean. So looking at 2025 market insights, I just wanted to remind everyone that at Endowus, we do not take tactical views or bets, and we do not give index level targets, but we do want to share some of the insights that we have looking into 2025. Next page. So I know this is a bit of a busy chart, but what it's telling you is the implied probability for the Fed funds rate during the whole of 2024. And you can see even visually that it's very, very busy and it's very, very volatile. So if you look at the dark blue line, that is the expectation for the Fed to have cut more than 8 times over the subsequent 12 months. And in 2024, you can see that that probability went from close to 0 to as high as 60%, and now again, very close to 0 again. If you look at another chart, which is in orange, that is an expectation for 1 to 4 cuts. That's been about 30% when it was low as 10, and now it's back to about 40%. The really interesting color is green, which is expectations of a hike. And while the expectations of a hike around September were close to non-existent, now about 30% of market observers are expecting a hike over the next 12 months. So the main takeaway from this chart is how difficult it is to project interest rates going forward, given the fact that a lot of the reasons for inflation and labor are on the heels of COVID and the normalization after COVID, which has never been seen before. Next page. So the good news, though, is despite us being in a relatively hawkish environment, growth has been very, very stable and resilient, particularly in the US. So what the left chart shows you is how, despite us being in a relatively high interest rate environment, the growth has really held up. And then on the right side, if you compare the money supply and inflation, inflation does have a very strong correlation to this, and the money supply is well back down below the levels it's been, many, many years ago. So we are definitely seeing normalization of inflation as well as, the economy. Next page. This may be a little bit hard to see, but what it's trying to tell you is the earnings growth expectation of analysts, particularly for the US market. And what it's telling you is that expectations for sectors outside of technology is also relatively constructive. So for example, healthcare, you can see that the orange, which is the 2025 expectation, and in blue is 2024. The ones on the left sectors are the ones where expectations for 2025 are even higher than 2024. So there is an expectation for a broadening of earnings growth outside of just tech. Next page. So some of the things that I'm talking about is already addressing some of the questions that are coming on. This is a chart that shows spreads, credit spreads as a percentage of yield. And what it's telling you is that credit spreads are a very, very narrow period right now, making credit actually very, very expensive. So with it, if you look at a bond, there is really two components to it. One is the actual risk-free yield, and the other one is the credit spread. And while the base yields right now are actually high relative to the last, let's say 5 to 10 years ago, credit spreads are actually, relatively tight. So what that means is that while it still makes sense to be invested in fixed income because of the buffer that the yield gives us, you have to be very careful where it is and the expectation for those spreads to narrow even further. So the good news of having a base yield that's high is that even if credit spreads do widen, that cushions that impact. So I know there was a question on, is it still a good time to be invested in fixed income? We think it is because base rates are giving you sufficient buffer, but you just need to be diversified into your risk on which types of credit you are. There are also exposures outside of corporate credit, such as structured credit, which are also part of certain funds that we have on our platform. So it pays to be diversified by subsector as well as manager as well. Next page. So the second point that we think are interesting going into 2025, other than interest rates and growth and inflation, is Trump. So Trump's second presidency is again uncertainty and risks for the markets. The biggest risks that the market sees from this are in the form of tariffs, which could come as a form of inflation and potentially lower growth for the rest of the world. So this is an uncertainty that we need to continue to monitor. On the positive side, we're looking for potentially lower corporate tax rates, as well as a more benign environment for corporates to operate, so which is a positive for the risk markets. Next page. So again, the going into Trump 2.0, what's difficult is that it's really difficult to forecast what the impact will be given the wide set of expectations and scenarios that you can see here. So again, the main takeaway from the situation is that you don't have all your eggs in one basket, that you really want to diversify by asset class and by region. Next page. The third continuous driver going into 2025 will continue to be AI and the adoption of AI. We need to see whether the adoption of AI goes beyond the semiconductors and the direct beneficiaries of AI into the enablers and the users of AI into different sectors. And what you can see here is really the earnings growth estimates of what we call the Magnificent Seven, which are the hyperscalers, and compared to the other sectors. So this is continue to drive the markets. Now the risk of the markets is that we are very concentrated in a few stocks. So what we call Batman here is really the addition of Magnificent Seven plus Broadcom, which is another new tech company that have reached $1 trillion in market cap. But again, really trying to monitor the concentration and the impact that these companies have on the rest of the sectors is going to be another factor that drives returns for 2025. Next page. So the question really is the positive rally that we've seen in the tech sector going to broaden into small caps? And when you look at US small caps in particular, which is represented by Russell 2000, as you see on the right, there is a very high sensitivity to tax rate changes, which is something that the market expects from Trump 2.0. And because of that, there is a relatively high likelihood that the small cap sectors could start to perform better than it has relative to large cap in the past. So this is another factor that we need to consider to monitor. And just as a reminder that, like Sean has explained in the performance, a key part of our core flagship portfolio is the systematic strategies through dimensional, and dimensional does have a tilt towards small cap. Next page. So I believe this is the last page or close to the last page, and the takeaway and the conclusion is clear. Uncertainties are rising. The volatilities of the market have actually been surprisingly low in the form of VIX in the last few years. So it's quite possible that the volatility will increase with the uncertainties that we've talked about. And the only free lunch within finance is really diversification. So it is very important that you reset your portfolio to see if it's really in line with your goal and whether you are diversified by asset class, by region, by manager. So what this chart is really showing you is really the different types of outcomes that you can see, which is very, very unpredictable. And with that, I think this is the end of the presentation itself. We will go over a few Q&As that we've seen. I'll take over maybe the first couple ones, and maybe Sean, feel free to jump in as well. I think the question that has the most amount of thumbs up is the classic 60-40 portfolio still working in the current stock market landscape? So I would say yes. So this portfolio, this balanced portfolio, is a portfolio that has been time tested for a very, very long period of time. There have been periods like 2022, clearly, when the correlation between equity and bond as an asset class went in a very positive territory, and so both asset classes have struggled. So there are periods like 2022, but on a rolling kind of 3-year, 5-year basis, and particularly in 2023 and 2024, 60-40 portfolio has worked. And I'll tie this in with another question that is somewhat related, whereby if the US yields are hitting 5% and beyond, and equities that are high P valuations, should investors reduce equities exposure? And the answer to that is it really is dependent. What you do with your equities exposure is really dependent on your risk appetite. It has much less to do with the decision of tactically reducing and increasing your exposure. So one thing to mention is that this is not the first time we've seen yields at around 5%. So if you go back in the 1990s, most of the 1990s yields were around this level. So because particularly the people who've been investing over the last 5, 10, 15 years are very used to a very low interest rate environment, it does feel like 5% is very, very high. But if you go back a little bit before that, it's been a very natural market. And that's a period where equities have actually done pretty well, right? So, and over the last, let's say, 12 months, we have been at a period of around 4 to 5% type yields, where, as you saw in the chart just now, the growth, particularly in the US markets, have actually been very, very resilient. So with US yields hitting 5%, the fundamental side of equities still looks reasonable. Now, the valuation is a different story. So yes, you're right, particularly in US equity markets, there are pockets of the market that look very expensive. Having said that, there are also other pockets of US markets, including small caps, including financials and other healthcare, for example, that were much more reasonable in valuation. If you look out of the US market, the valuations again look very, very reasonable. So equities as an asset class, assuming the fundamentals are actually sound, is something that you should continue to invest in for the long term. So the decision to either reduce or increase equities should be dependent on your risk appetite as opposed to a tactical view in the markets. The same thing about equities could have been said in 2020, at the end of 2023, but 2024 was an equity market where it was up about 20%. So maybe I'll stop there. Is there any question you would like to address, Sean?
Just wondering whether you want to start with the China stock market outlook first, and then I can add on a few points on that question.
Sure. Okay. So the third thumbs up question is, what is the outlook for China stock market in 2025? So the Chinese stock market has gone through a very difficult period over the last, let's say, 3 to 4 years for a number of different reasons. A lot of it has been due to the real estate and the property sector as well. There's been a loss of confidence. But knowing this, the Chinese government has actually come up with some comprehensive policies in September 2024, and then there's expectations for some follow-up policies as well. So, like I mentioned in the beginning, we do not give targets for the markets, but when I look at a confluence of valuations as well as what is expected in the market, I think there does look like the downside risk is relatively limited in the Chinese stock market, number one. Number two, Chinese stock market is the second largest market in the world by liquidity and a lot of different measures. So it is a very important diversifier to US equities. And just going beyond China stock market, the Asian stock market, including China, Japan, India, Taiwan, etc., has actually been the second best performing region last year, with the entire region up about 8%. So underperformed global equities by about 8%, but it actually outperformed global equities ex-US, so making it a very good diversifier. So that would be the second. The third thing is that we are seeing onshore investors starting to invest in the Hong Kong market as well, and which in the past has been a precursor for foreigners to come in as well. So foreign investors have been very skeptical of the Chinese stock market, trying to see whether the new, boosting economy measures will actually result in higher earnings and consumer confidence, and that will likely be a bit of a drawn process. So we think that China does play the part of being a diversifier for the U.S. market, and you should definitely look at opportunities there as well.
Thank you, Hugh. Just a quick add-on to this question. I think also when we were doing the portfolio review for our China equity portfolio, we noticed that there seems to be weakening of the market optimism in the last quarter, despite all the policy announcement in September. And one of the reasons could be that on the surface, this policy may not be perceived as a direct policy of addressing consumption issues. Policies such as local government, hidden debt repayment, housing support, housing price support, all these policies may not be seen as directly addressing the consumption issue, but what the likely outcome could be that all these policies are addressing the employment issue and also rising housing prices, which raise consumer confidence. And all this likely outcome indirectly address the consumption issue. So the markets are, I would say, governed by both fundamentals and emotions, and all these things we have to take into account when we look at the market and when we make our investment decisions. And also, just a really quick recap is that even though we have the satellite portfolios like China Tech Megatrends, that's not the only way for our client, for you to express your market view, to express your conviction. We also have our FundSmart platform where we can go in and do your DIY portfolio, invest in single funds. So tying back to question 2 and this question on China outlook, if you have a particular view on China, bullish on China equity over the long term, you can go into our FundSmart platform to buy single funds. If you're worried about equity valuation, you can go into our FundSmart platform to look for strategies that has more value focus, so that relative to a passive index funds, the valuation of the fund would be lower, for example. So that's also something that you can consider as a client, not just looking at our portfolio, but also utilize our DIY funds platform.
Okay, so let me address a question that we think about a lot, which is the performance of the satellite portfolios. The question was and it has actually been addressed, but I do want to add a little bit. Is really the satellite portfolios are a way to give you exposure to a certain overlay of the core portfolio. So, for example, the recent portfolio change that we did for real assets. Real assets are assets that would do well during periods of stagflation and stagnation, which means when inflations are sticky and when growth is not as good. And so there's a specific purpose for certain satellites to be an augment for your for your core portfolio. That's number one. Number two, what's really happened in the market is, as you saw in the 2024, is that there's been only a handful of stocks that really drove a big part of global equity markets, not just even US equity markets. And this played a very, very important role on the performance of active managers versus passive indices. So given that our active management composure of satellites are much higher, this really became a headwind for the performance versus the benchmark. ESG, for example, by nature, a lot of the constituents of the company are longer duration companies, because whether they're renewables, whether these types of companies tend to have longer duration, which actually again suffered from not being part of the Mac 7, et cetera, et cetera. So the important thing is that what do we think about going forward? Are we are they going to play a part in the portfolio going forward if you wanted to have exposure to China or tech or real assets? And we've gone through what we call the recommended portfolio change throughout 2024, where we really thought hard about what we're trying to achieve with these portfolios, and so we've made it. We think we've upgraded it to a very good level. So I encourage all of you to look at it again. So the performance is very backward looking, and a lot of it is because of duration as well as the performance of Max 7. But I think it's very important to look at it on a forward basis. And with that, one other question was, what would you change in the Endowus core portfolio allocation, given that market conditions have changed from 2024 to 2025? And again, I want to remind you that the composition of the core portfolio is a procedure that we use, which we call strategic passive, which is basically we put in strategic allocations, and you can choose the risk that you are comfortable with. So, for example, if you're aggressive versus 80-20 versus 60-40, we are not the ones that allocate the equity allocations for you. It's you that decide. And for the sector and the kind of regional tilts, we try to keep it as core as possible. And therefore, it's not a tactical portfolio. It's a portfolio that is supposed to reach your goal over the very, very long term. One other incremental point I wanted to answer is this, and which actually answers a previous question on is a 60-40 still valid? And there are weaknesses to a traditional balanced portfolio, which is the reason why we've created what we call core enhanced portfolios for our accredited investors with the use of liquid alternatives. So that's again a way to try and systematically make the most out of the risk budget that we have. But again, what we don't do is we don't take market views, regional views, and sector views.
Thank you, Hugh. Maybe I'll just take one question. We just got upvoted, which asks about the fixed income performance compared to its target payout, and whether it would be wise to just put the money in fixed D or cash smart portfolio. So I think a key role that we do at Endowus and also in investment office is to understanding our clients' need and to create a bespoke investment solution for our clients. So in this case, I would say that it really depends on what's your objective and what's your investment horizon. Obviously, if your investment horizon is 1 year, then the portfolio that you can consider would be very different from if you want to invest over a period of 5 to 10 years. Our portfolio, we design the portfolio with our client's objective in mind, with different level of risk. So starting with the lowest risk for our portfolio are the cash smart portfolios, followed by our flagship 100% fixed income portfolio, and also our income portfolio, stable income, higher income, future income, etc. So if you are looking for something that manage your cash in the short term, then I would say cash smart portfolio would be something that you can consider. If you want to, grow your wealth over the long term, and you don't want to take as much equity risk as your counterparts, then you can consider a flagship portfolio that is either 100% fixed income or has a higher allocation to the fixed income side of the portfolio. And of course, if you are looking for a slightly longer investment horizon, let's say 5 years, but at the same time, you are looking for a monthly payout. Stable monthly payout, you can consider our stable income portfolio. If you are willing to take a little bit of a little bit more credit risk, then you can consider our higher income portfolio, for example. So it really depends on your objective and your investment horizon, which will lead to what's your risk appetite. Just one comment on fixed D. Of course, all our investment comes with risk. The fixed deposit also comes with its own risk, which is very different from investment. So I would urge you to consider them separately. But of course, if with more risk that you can take, there are more options that you can do. For example, if you are willing to take the credit risk that stable income portfolio has in its portfolio, then the monthly annualized distribution yield of 5.9 to 6% is something that you can look to achieve with our stable income portfolio.
Okay. There's one question that has not been answered, which is fairly high on the thumbs up list, which is, keen to see funds that leverage optimal portfolios like NTSX, RSSB ETFs, but UCITS. Has the team sought to bring in this flavor of funds? So, okay, without going into details, I mean, ETFs is an asset class that we currently don't have on our or a type of structure that we don't have on our platform, that we are continuously doing work to see if we should bring on. And there's a lot of iterations in that. And part of the reason is because some of them are not available on a unit trust type of format, some of the ones that you explained. So the way to answer this is we are trying to offer more solutions to our clients, and it's in the works. But we cannot promise anything at the moment, but we are definitely looking into interesting solutions and strategies, particularly in this period where a lot of people are worried about equity markets as well as inflation and so on and so forth. So the answer is we are looking into it, but we cannot specify anything specific on that. And
maybe I also take
Sure.
one more questions. I think there's a question on when can we expect size and value premium to turn around. I think the short answer to this question is we can never time it. Nobody can time it. But the question then is, why are we doing it, right? So I think this ties back to what Hugh was mentioning just now as well. Over the long term, we want to be in equities if we can take the risk, but the problem with equity is its volatility. That's why traditionally we combine equity with fixed income. For our co-enhanced portfolio, for our accredited investors, we also include other strategies that have low correlation to equity to further dampen the volatility. So all these fixed income, other strategies are there to lower volatility, but each of them also do not work at a certain period of time. So this works similarly with factors, which is we want to be in the factors already, and when those factors do turn around, we are already there to benefit from these factors. Because chances are when these factors like value, size, profitability, premium, when they do turn around and you want to get in, then most chances are we are already too late. So the reason why we still want to be in these factors is because we want to be ready when this factor premium do turn around, we are already there to capture its upside. But at the same time, we understand that if you are concerned with having too much of this, I would say factor tilts, you can consider our flagship portfolio, which has kind of like the best of both worlds. Because on the equity side, the flagship portfolio is actually a combination of pure passive index fund, mutual funds, and also dimensional funds with slight tilts towards all these factors that you mentioned. So you will have best of both worlds on the equity side if you look at our flagship portfolio.
Yeah, in the interest of time, I'll probably try to capture the last few questions that we have. One is a question on the yield curve, as well as should we be in the shorter end given what you explained? And I think yield curve steepening is happening because in the past it's not a natural state to be inverted, which means that you don't get compensated for the long duration that you hold, which we call a term premium. And so the natural state is for longer term yields to be higher than short term. So that will likely happen over a period of time. It's already been happening. Now, there are two types of yield curve steepening. One is where what we call bear and bull, which is if all of it is going up and steepening, or all of it is going down and steepening. So that also determines, on whether what sort of duration you should have on investment. So our stance again is not to have a specific view on that, but really rely on our best-in-class managers, such as PIMCO, who've been managing this very, very well. And right now, some of them are in shorter duration because of the phenomenon that you explained. So it would really be about letting the managers do their job and determining where the right part of fixed income should be. The other kind of bundle of questions were on diversification. Is India a good market to be diversified in, etc.? I would say generally trying to find regional diversification outside of the US are all additive. Also, diversification outside of equities are also additive as well. And Indian market has been a growth market for the last few years. And it's important to look at what the growth drivers are and whether those growth drivers are actually very correlated with global growth or not. And given that a lot of the growth drivers in India are actually quite domestic in nature, logically speaking, it should actually help with the diversification if you have a very heavily US dominated portfolio. So I think the short answer is yes. But it's not just India. I think it's other markets, China, for example, that we explained, where you should look at opportunities to diversify your regional allocation as well. And I think with that, we will probably have to wrap up our session today. But if you have further questions, you can, check in with our client advisors as well, and we'll be happy to address your questions. So with that, thank you so much for spending your lunch with us, and Happy New Year.
Thank you.